Morning, guys. Everdassy Hancock Mortgage Partners. I am here live with the one and only Johnny Fowler, Executive Vice President at Hancock Mortgage. We thought we'd get on together today and share some information on what's taking place in the real estate market and also what you guys can be doing to continue your marketing as we go forward in these unprecedented times. So, Johnny, give us an update on what's taking place in the market and what people can expect in real estate and mortgages right now.
Right now, on the consumer side, things that I would expect are completely different than you've ever had before. If it was me and I was a consumer, I would make sure that I have all of my ducks in a row. I had all my paperwork ready. I would have everything to my loan officer the minute that they ask for it. If they ask for driver's license, if they ask for bank statements, paycheck stubs, whatever it is they're asking for, I would have it to them in minutes. I would make sure that my phone was on, and I would make sure that I was accessible, and I would make sure that when that loan officer called me and told me, one, it's either time to lock or what's going on in the market, I was paying attention and I had no distractions. If I was a loan officer, if I was doing production itself, there are things that I would be watching. I would give my consumers, my customers, and my referral partners an update at least once, if not twice or three times a day. Let them know what the market's opening at, what's going on midway through the day. Let them know what's going on at 3:30 Eastern time to know what happened with the market that day. Let them know what this is, because we're in times that we've never seen before. And we have things, there are many, if you look at our industry, it's here, but there are so many outlying things going on that it is affecting what we know of as our industry. Normal things that usually happen when the bonds go up, mortgage rates go down. When the market goes up, mortgage rates go up. So right now, there are so many outside factors going on. And one thing that we saw just here in the past couple of days, over the weekend, theoretically, is what's going on with government loans. It is not HUD, it is not FHA, it is not VA, it is not USDA. It is the secondary market worried about buying loans at one price, and that price either dropping dramatically or raising dramatically during this process to try and keep up with what's going on in the market, what's going on with demand. So two things to take off. Consumers, get your stuff ready right now. When that loan officer calls you and says, get your paycheck stuff ready, get it ready as fast as you can, because they're going to be your greatest source in purchasing and refinancing that there is. Don't listen to your uncle or your cousin or somebody who took a finance class back in 1984 at a junior community college. Listen to your loan officer, because this person is going to help you more than anybody else. For the loan officers, for anybody in production, communicate, communicate, communicate. Don't sit there and just hold it all in. Don't sit there and think that everybody knows what's going on. Communicate, let them know what's going on.
Absolutely. So I kind of look at it this way. When people are at war, they get information from the front line, the people that are there that are seeing what's going on, so that the generals can make decision on what's taking place. Your loan officer is that soldier on the front line that's going to be communicating to you what's taking place. Listen to them, move forward with what they tell you. You and I discussed this the other day. We talk to people all the time, and we get the projection from borrowers that aren't in the industry, that talk to their aunt or their uncle or their cousin, that says interest rates are going to go lower. And it's a race to the bottom. And 90% of the time, I've been doing this for almost 25 years, I've never been able to catch the bottom. It's kind of the analogy of catching a knife as it's falling. I may get it at the bottom, but it's probably going to be painful when I do. So pay attention, listen to your loan officer. If 3.5 interest rate saves you $400 a month, take the 3.5 and save the $400 a month. I've talked to several people that, hey, I can get you this rate today, whether it be 3.5 or 3.75. And now I'm looking at rates at close to 5 for them, even though the mortgage-backed securities are outrageously well priced and we should be seeing better rates. One of the things that you put in there is secondary, looking at what's the fear that's taking place. And I think a big part of the fear driving rates where they are these people going to be able to pay their mortgage going forward due to what's taking place with the self-isolation or the stay-at-home orders?
It's huge. You got to think about this. We're talking about business. We're not talking about, and it's very hard to split the two. By the way, you said something that just hit so hard, so home, the lowest rate. It's a good friend of mine, Dale Vermillion, says this one all the time. If you're looking for the lowest rate, you're going to spend years trying to find that guy that has the lowest rate. And when you find him, he doesn't have the lowest rate anymore.
Absolutely.
So, right now, rates are amazing. I just got off of a call with some of my recruiters, and they were talking about right now on a VA loan, it was pricing out at 3 5/8 with, I believe it was a point discount. And that's a wonderful, great thing. My God, I just, really think about it. Would you loan your best friend money at 3.5%? I know I wouldn't. I just give it to him and assume that it was going to happen. So I want to hit on that one real quick. You're 100% correct. As far as pricing, man, we are in times, and if you're waiting on something that you have no idea, I think the comment that you and I were talking about the other day had something to do with, if I knew when the bottom was, or if I knew when the top was, we probably wouldn't be having this conversation, because I'd be so filthy freaking rich. I wouldn't even be on a phone. I'd have somebody else answering the phone for me. You can't pick it. You don't know. And even the guys, the Barry Habibs of the world that are the best in the business by far, can't tell you what the low is, when it's going to happen, what the high is, when it's going to happen. They can give you speculation. They can tell you what they think. They can tell you why they think that, but nobody can tell you what the bottom is. The difference between a 3.5 and a 3 3/8 is so null and void. But if you're waiting on that 3 3/8, you're going to miss it, and your 3 3/8 is going to turn into 4.5 or 5.
Absolutely. Absolutely. Yeah. I mean, the comment was that I tell everybody, if I could predict the market, you'd never talk to me. I'd be on a beach somewhere counting my money out of my foreign bank accounts just to make sure I was protected. I would be filthy, stinking rich, and nobody would get to talk to me.
Agreed.
I told a client the other day, if you want projection on the market, call Warren Buffett. If you can get a hold of him, maybe he'll tell you what's taking place, but it's that type of scenario. We don't have the ability to predict the market. Our crystal ball broke. We threw it at the dog. It no longer works, however you want to look at it. And we're in one of those times where it's changing so fast. Even the guys with their finger on the pulse are being surprised to some extent about what's taking place. We're seeing so many different moves. The Fed has, over the last 2 weeks, purchased $250 billion worth of mortgage-backed securities, which is causing an issue in the mortgage industry with margin calls and other things like that to lenders that aren't set up correctly or are being surprised by it. So it's really hard to predict what's going to happen. Let's see here. So what can your real estate agents, your loan officers, the guys like that, we're in unprecedented times. I'm locked in my office. You're in your office, but we're basically quarantined where we're at. What can they be doing in order to make sure they're putting out good information and that their marketing continues?
A number of things. I would be innovative. Whatever it is, whatever is different. One, I'd be in communication. I would I've read and I've seen things that people are saying, and people, a good friend of mine, Leo Goretti, says it all the time. Wine is good. God is great. People are crazy. Stop listening to the naysayers, the people who, I actually saw somebody saying something the other day, that this is the end of the world. We're all going down, blah, blah, blah. We're in the final days. And I'm thinking to myself, where do you come up with this? Where do you find this information? And on top of that, I mean, I saw this in one of the real estate groups. Somebody said this to one of the agents. Why would I want to buy a house now when the end of the world is near? Well, I'm going to spend my last days in a freaking mansion. It was me. But so realtors need to be innovative. Some of my friends, I watched Jeff Michon probably 3 weeks ago start telling his customers, let me know what properties you want to go to see. I'm sitting here at home anyway. I will go do virtual tours for you. I will send you pictures, whatever it is. Right now, and especially, I'm hoping your agents pay attention to this one. There is going to be such a pent-up demand in 4 weeks, 8 weeks, whatever it is, that this thing starts going down. And that's not me predicting. That's just me watching what the doctors are saying. There is going to be such a pent-up demand that I would know exactly what was on the market. I would know exactly what my people want, because if you don't, someone else will. That's the big thing. Communicate. Talk to them, help them, set their mind at ease. We're in weird times right now. Help people. That's it. Just help people. That's the biggest thing. Do virtual tours. One thing I can see our guys are doing. Patrick Quayle does a great job at this. Patrick Quayle once or twice a week goes on and does a virtual tour inside of his local MLS and shows people houses, spotlights houses of the week. Do the same thing. Find out what's going on in your area. Find out what people want, what they need. Be innovative. Do something different. You're all watching some of the funniest things you've ever seen in your life. The people walking around door to door dressed as Legos. I get a kick out of how many people aren't paying attention to that. But do something different, man. Be innovative. Just reach out. Talk to your group. Talk to your syndicate. Talk to your sphere, whatever it is, and help people.
Absolutely. So this is one of the things we discussed. I want everybody paying attention to this right now to think about something. We have people that have spent 4 or 5 years in a house. They get up at 6 in the morning. They're out of the house by 7, and they're at work until 5, 6 o'clock at night. They go to the gym. They go pick the kids up. They get home by 8, 8:30 that night. Dinner. Kids are in bed. They're in bed by 9:30 or 10. So the amount of time that they spend in their home is pretty limited on a general basis. Now, take those people and put them in there for 24 hours a day, and I guarantee you they're going to see everything that's wrong and that they dislike about their house. I need more room. I hate that tile, blah, blah, blah. I need an office that's separate from everything. I need this. I need that. And what's going to happen when they come out of this stay-at-home order? They're going to be looking at, okay, now everything's good. My job's good. I've got money. I'm going to get what I want in a house. Or they're going to go get a car. Or they're going to go out and spend, because we've never been in a time where it's not that you didn't have the money to spend, it's that you're not allowed to go out and spend it.
Yep.
So I think we're going to see a huge rush in housing, which hopefully we see a little bit of change in inventory. Inventory has been pretty low here in New Mexico, which has driven prices up a little bit. But I think that those people are going to be putting their houses on the market and buying a new one. We're going to see some boom that takes place. Personal opinion on that, I have absolutely no background in projecting the market, as I said before, but that's what I think is going to happen just from talking to my wife, because she's talking about all the stuff we're going to do when she can leave the house.
I think, and this is when, again, where being innovative would make sense. I would probably talk to my audience and ask them, if it was me, I would ask them what it is that they like about their house that they're quarantined in, what it is that they don't like about their house, what it is that they would change about their house. And I would pay attention and listen. It's like, I assume you guys, you're actually spend a lot of time here in Texas, so you know this. We've got a saying here: God gave you 2 ears and 1 mouth. Listen to what they're telling you and help them. Being quarantined with a bunch of kids inside of 800 square foot has to drive you absolutely insane. 1,600 square foot, whatever it is, pay attention to what is. And if you'll also think about this, you can buy so much more house for such a smaller amount now because of interest rates. You know, when I bought my first house, I'm sorry, when I financed my first house in 1994, I financed my very first house, and it was $73,000, corner lot, swimming pool. And I knew that I was scared to death that payment was going to freaking kill me. And I think my payment was like $843 or $853 a month, something along those lines. And it was just astronomical. Figure out what that is on today's rates, what your note would be on a $73,000 house. Today, you can buy so much more home for less money. I'm betting you can almost buy twice that nowadays for that same payment, because at 8.5% interest, that's what I was paying at 8.5% interest. That is a huge difference in what your principal interest is, incredibly.
Yeah, this is a conversation I had with realtors, and I said, look, call everybody you've closed in the last 5 years, last 10 years, whatever it is, but make contact with them and tell them, call a lender, look at refinancing. What situation are you in? And ask them the questions. And one of the realtors said to me, why would I do that? It's not going to do anything for me if they refinance. Here's what it does for you. You are building a relationship with that person. You're going to build a lifelong relationship where they walk out of there and go, you know what, my sister wants to buy a house. Let me refer them over to Joe at whatever realty company, because Joe was looking out for me. There's more to this business than just that immediate commission. And one of my good buddies, David Kaywood, says it best. When I'm dealing with someone, I'm not worried about the commission on their deal. I'm worried about the commission that's going to come from their referrals, from their friends, from their family, because if I give them good service, I'm going to get that. And that's the thing about reaching out and saying, hey, now's a great time to look at refinancing. And you may find that, hey, I hate it here. I want to move up. And that $250,000 deal you sold them 3 years ago is probably a 350, maybe even higher deal based off of interest rates and their income growth.
So now they owe 230 on something that's worth 330.
Yep.
Yeah. One of the things, you know, I heard that one before also. I actually, in one of the real estate agent groups, I was reading something about that. But you know, my response was, and it wasn't taken very popularly, but my response was, when they were talking about that, is I said something to the effect of, how many mortgage guys have ever referred you a deal, a real estate transaction, where the people were paying in cash? How many deals has your mortgage guy referred you when they were already pre-approved, or maybe it was a you know, like the one that I referred to you guys?
Yep.
At the time, we didn't know if that was on a buyout package or if it was on a move package to where they already had the money set up, anything like that. And the cool thing about that is nobody even asked. It was just helping somebody. It was helping my friend's mom find a place, because she didn't say in the whole thing, hey, can you give me a lender to help me finance? What they said was, do you know a good realtor in the Albuquerque area that can help me find a home? And guess what? Everybody jumped on it, took care of it. And lo and behold, it was exactly what we wanted. But it's just helping people, because I know that there's been many times that not only you, that Mr. Checo, whoever it was, has referred deals to real estate agents, to other referral partners. We do this all the time. We refer people to investment people. We refer people to attorneys, to you know, so many other pieces. It's just being seen as that helpful person.
Absolutely. Insurance is a great one. I refer people out to an insurance agent all the time. I don't make any commission off of them using an insurance agent, but I do know that when I refer them to that person, I know they're going to be taken care of, because that reflects on me. And so, you know, it's one of the things that we can be doing is looking at who we've helped and continue to help them going forward, regardless of whether it makes us money or not, because that pays off in the long run. So now we're seeing, I mean, MBS today, mortgage-backed securities today, we're at the 2.5 mortgage-backed security, which is something I never thought I would see, at 4.52, 104.52. And we're not seeing that translate into rates. Can you explain a little bit why we're not seeing that?
A couple reasons. I can go pretty deep into it. I'm going to try and hit the surface. So you're talking about the 2.5-year I'm sorry, the 2.5% coupon is at 104.52. Think about this. So with what we've seen, and I assume you've seen that candlestick graph, where at the end of it on the last day, it's got the scribble at the end of it. So here's what's going on with that. So banks are in the business to make money. There's a reason why they pay you a smaller portion. They'll pay you half a point while they're loaning your money out at 4 or 5 times what they're paying you, because they have to make money. That's number one. If they don't make money, they're not in business. If they're not in business, the banking, we're not in a capitalistic society. So here's what their point is. Why on earth would I trust this market and put out a rate at 2.5 right now, when right now the whole world is at a market of 4% or 4.5%? Why would I do a disservice to my investors? Why would I do a disservice to myself, my money, when the market is going crazy? Why would I do that? So there's a couple reasons. We're not only not pricing at what you and I think we should be at the bottom of the market, we're also not pricing at the top of the market. Because if you look at it this way, if we're selling loans at 4.5% interest, and if the market does shift down to, let's say, a 3.5 market, think about this. What happened was everybody just closed loans at 4.5%. They were shipped all of the information, they were shipped all of the collateral, and now there's another refi boom. So everything I just bought is now suspect to being refinanced. So here's what happens. When a mortgage banker sells paper, and that's what the mortgage is called, when they sell paper to an investor, that investor pays them 100%, usually, of whatever it is that they bought. So if somebody bought $100,000, they pay them $100,000 plus basically what is considered almost like a finder's fee or an origination fee or a third-party origination fee. So for $100,000 transaction, they may pay me, like you're talking about on this 2.5 coupon, they may pay me 2.5 points. So $2,500 for delivering this to them, which isn't a whole lot of money. Now, if somebody refinances that loan that I just closed them, and they closed at 4.5, and now they're closing again with somebody else at 3.5, then instead of just intaking in that good, intaking in that product and putting it in the portfolio and servicing it, sending out the coupons, and letting people know what's going on with their loan, instead of that going on, now I've got to take those same people. They have to gather up all of the information. They have to submit and transport that file electronically to a new mortgage investor. Then they have to send out an early payoff notice to me, who sold them the loan, saying this loan did not perform for the agreed amount time. So now you have to pay me this money back. And it's not free for them to do this. What they want to be doing is taking in the product, taking in the paper, servicing the paper. That's what they're in the business for. They're not in the business for holding for something for a few minutes, a few days, few hours, whatever it may be. So right now, with rates doing this and not sure where it's going to be, they have to the secondary market has to kind of stabilize it themselves. So instead of going off of, let's say the 10-year is this, the stock market is this, Fed funds rate is this, and having some sort of parameters to go off of, some sort of static parameters to go off of, now they're having to figure out, okay, they're having to play basically actuarials. So if this happens, this is what's going to happen. I've got to be here to maintain the business that I've built. Does that make sense? Am I talking? Sometimes I've got a problem, and I'm trying to make it understandable. But if I'm not, just say so.
Yeah, and I think it makes sense to me. But again, I've been in the business for 24 years, so I've got a basic understanding of it. But one of the things I think everybody needs to realize is that seller servicers are in a predicament. And the simple fact is that in one hand, I have my servicing, in the other hand, I have new volume. With rates when they hit 3 weeks ago when we were locking deals at 3%, something north of 33% of all actual mortgages were eligible to be refinanced. So as a seller servicer, when I'm servicing loans, do I work on my servicing and make sure I keep these, or do I work on new business? And it becomes a funny balance that they've got to take care of. And then you add into, on that day, if I remember correctly, PRMG said they had $1.5 billion worth of loans locked that morning that came through.
Yes.
Yeah, that came through that morning. That's a huge amount of volume to try to put through the system. So we've got to look at what the capacity is, and it's a fine balancing act right now. I mean, this is Circus Olay in the mortgage business on how do I get across this tight wire, carrying a hula hoop with a baton and catching someone as they fly through the air. We have to really pay attention to the servicing, our capacity, and do we stop new business in order to protect servicing, which is our bread and butter in the industry? Or do I bring in new volume to replace what I may lose with rates? So it's a very difficult situation that lenders are stuck in.
And you just made a great point, because I can only put so much through that pipeline. So if I start servicing my $500 million worth of loans on this side, and I'm still bringing in $1 billion worth of loans on this side, I can only hire so many people. I don't ever want to hire somebody just to lay them off. That's one of the big things you've got to look at from the mortgage company's standpoint right now. You don't want to bring somebody in because this is a short-term deal. This isn't going to last for any long period of time. That's one of the reasons why I'm telling borrowers, get your stuff together now, because this will not last. How long this is going to last, I don't know, but it will not last. So you've got, like you said, you've got customers on one hand, you've got new customers on the other hand, and you've got to take care of both of them, but you only have so many administrative staff personnel, and you don't want to double that. If you double your business, you don't want to double your administrative staff, because at some point it's going to die off. It's going to go back to what the new normal is at the time. And when that happens, one of the worst things in the world to do, and usually, you know, you've been in it for 24 years, I've been in it for 26 years. We know when October comes around is when there are mortgage people looking for jobs. That's usually when the layoffs happen, things like that. So what we don't want to do is hire 30, 40, 50 underwriters to get rid of 30 or 40 or 50 underwriters in a week, a month, 6 months, whatever it is. We don't know what that time period is. So you've got a tremendous amount of moving parts happening, and you've got to operate status quo times 1.5, not times 10.
Absolutely. I mean, here's the interesting thing. So this is something we talked about in 2008. We lost liquidity in the mortgage industry. There was not money to fund loans. And that's because every lender out there, their book was performing terribly. We saw a huge crash brought by real estate, or however you want to look at it. There were other factors, but we lost liquidity where we couldn't fund loans. This was a conversation that I had with you and that I've had with my wife. The total opposite of that is taking place right now. So in 2008, we couldn't fund loans, and we didn't have any loans to fund because it completely dried up and everybody hit. Now we have money to fund loans, and we have loans that can be done. So it's a totally different thing. And I think that what everybody needs to take out of what's going on right now is that the pause button's been hit, not on real estate and not on buying and selling and refinancing homes, but on the economy in general. We've pressed the pause button and said, okay, everybody stay sheltered in place. We're going to figure this out. And it's just a pause. Basically, they're watching Netflix. They paused the show. Somebody went to the bathroom. When they come back, this is all going to start again. Do we know how long it's going to be? We don't. I think there's a ton of different projections out there. Trump said June 1, he thought we'd be going back. There's projections that we're not going to recover for 18 months. The simple fact is that regardless of who you're listening to, understand they don't know. They don't have the exact date that this is going to take place that we can say. And that's what we talked about in the beginning. We can't predict the market. We do know that this is going to be a short term because the economy was roaring when we went into this. Nothing brought the economy down except for the shelter in place and, hey, stay home. And
I've got a little bit of disagreement on that. I think what we've seen, first of all, I want to hit on one more thing and add to what you just said. You're 1,000% correct on the product, on the loans, on the consumers. There's one thing that you need to add to that. We had so much freaking inventory at that time. We had more inventory than we had buyers. That's another thing that you need to throw in there. That's why people need to realize that their home values aren't going to drop. And I can't guarantee that, or, you can't count, on me, but the inventory difference at the time when 2007, 2008 happened, we probably had 9 months, 12 months, 14 months worth of inventory when that happened. So the supply was too high for the amount of demand. The only demand at the time was speculation that everything was going to keep going up, keep going up. And the problem, we had less consumers when that happened. So that's one of the big differences right now. If you'll look and you'll talk to any real estate professional, they'll tell you that inventory is down across the nation, period. I've read national home builder stats that 500,000 homes shy on inventory every month right now. So there's a huge difference there. Yes, the economy was doing great. No ifs, ands, or buts. But one of the things that we've learned since then is part of the stock market, which is, what a lot of people think as of the economy, that there were some false positives in there. And that's where the stock market being called on margins happened. And it just so happened that it happened at the same exact time. So there may have been some overinflated stock prices, and I don't know which ones were and which ones weren't, any of those things. And they were bought on margin. And what that means, if anybody's watching, you don't understand what margin is. What margin is if you'll kind of think of it this way, margin is a secured credit card. So if I want, let's say, if I want a $10,000 credit card, the bank is going to make me theoretically put up $1,000 to give me $10,000, and then I get $10,000. So what's going on in the market, in the real estate business, in the financial aspect, financial industry, things like that, are things move so fast that it's not truly cash changing hands. So if you go to the supermarket and you want to buy $100, whatever it is, you hand them $100, they hand you that product. Well, there's so many pieces, so much stock is being bought so fast that they cannot exchange cash fast enough to make that work. It would stop the world if they did. So here's what happens. Stock brokerages have theoretically a line of credit with the stock sellers or the stock exchange. So they're allowed to buy so much stock. And what happens is, let's say I've got, same thing, I want to buy $10,000 worth of stock and I put up $1,000. Well, at the end of the day, the advisors who are accepting this, the brokerage houses that are accepting this line of credit, say, whoa, wait a second. We don't think XYZ company is going to stay at that level. We think it's overinflated prices. So what you're doing is you're buying this stock, you're turning around and you're reselling this stock. And what happens is once you resell it, then I get my money back as the middleman. So what they're doing is they're saying, okay, normally when you buy $10,000 worth of stock, you profit $1,000. So what I want is, I trust you, but I trust you from a distance. So send me $500 more, That's half of what you usually make when you sell this stock. And I will trust you more. So instead of having $1,000 there, theoretically, you've got $1,000, you have to send $500 more. And then when that stock that you have sells, then that $500 is taken out first. You're back to your $1,000. So the margin call is called on that theoretical portfolio. That may be a little bit off, but I'm trying to make this simple so everybody can understand it. So what it's saying is the broker dealers are saying that, yes, we believe you, but we're not sure if we're going to get our money first, and we want our money first. So send me a little bit of money that I'm going to make on this. Now, here's what happens. Right now, let me go back about, I guess, 6 weeks ago. And actually, it was before that. The first margin calls really started happening in the fourth quarter of last year. And what was happening was so much stock was bought on margin. When the margin calls came in, people were having to sell their stock. So if you bought stock at $100 and you bought it on credit, now you're having to sell that stock to liquidify, if that's even a word, to get liquid on the margin call. But remember, you borrowed that money to buy that stock. So if that stock price has fallen, so let's say the stock price, you bought it at 100, now it's worth 60, and you're selling it off at 60, you're not really taking a $40 loss because you bought it on margin. You didn't actually have money in there to buy it. So when you sell it off at 60, you're theoretically only making 30 to pay your loan back, your margin, to get it off of your books, to be able to continue doing business. So you bought it 100, you're really liquefying at 30, and that's part of what started. But then all of a sudden, when coronavirus started hitting, I think we saw the first cases here, I think were February 16th is what I saw. I don't remember the exact dates. But then all of a sudden, so that just exacerbated what was already happening. So yes, the market was doing good. Yes, it was a little overinflated, but then all of a sudden, all of this stuff hit together at the same time. Does that make sense? Again, man, I know that I'm really bad at trying to explain this.
Yeah, easy way to look at margin calls is if you have a credit line of $5,000 and you've had to put $1,000 into it. If the market changes, your lender calls you up and says, okay, you've got $1,000 in on this credit line that you've maxed out to 5. I want another 1,000 to hold the position. And the problem with that is that as you continue to take those, so 1,000, now you're at 2,000, and then the market gets worse, and hey, I need another 1,000, now you're at 3,000. Pretty soon you're capitalizing that whole credit line on your own. And when we're talking about thousands of dollars, it's not that big a deal. But when we're talking about big broker dealers and people that are doing this, this is millions and billions of dollars.
Hundreds of millions.
Hundreds of millions of dollars that are coming out of people's pocket in order to hold their position and keep everything rolling. Because we look at it in the lending industry as loan to value. If you're at a 50% loan to value and we'll loan you more on top of that, those loan to values start coming down as the market changes. As the market goes lower, you're losing money. So the broker dealers are going to ask for more cash from you. On the individual side, it's generally not that big a deal unless you're a big player, but on big companies, it is, and it can be catastrophic. And that's one of the things we talk about in real estate between mortgage bankers like us, correspondent lenders, stuff like that are hedging our own rates, and the brokers, that the brokers are going to take a bigger hit in markets like this a lot of the times than we are, but we haven't seen the full effects of it. Early payoffs, first payment defaults, which is a big question on how's that going to work with forbearances and stuff like that in the market. How is that going to affect your broker that's a two-man shop? One deal puts them out of business. I mean, this is unprecedented times, and how do we handle it?
One thing that I really want you to hit on, and I want you to hit on this every single day as much as you can, is people are watching the news and they're seeing stories happen saying that you don't have to make your next 3 mortgage payments, things like that. I want you to please let everybody in your viewing audience know that you can't just stop making your payments. You sign an agreement on your car, on your credit card, on whatever it may be. You made an agreement, and unless you notify that servicer, you're not just getting a free pass on not making your payments. So if you have an issue, if there is a problem, if right now you're out of work, if you don't have the money, whatever it may be, you cannot be embarrassed. You have to pick up the phone. You have to talk to your servicer. You have to call whoever it is, regardless whether it is, one of the big 3 car manufacturers, whoever it is, your mortgage company, whoever it is, whoever's servicing your loan, you have to call them and talk to them. Don't just stop making your payments, because what's going to happen is if you just stop making your payments without letting somebody know, without putting somebody on notification and them agreeing to letting you miss those payments, you're going to screw up your credit. And if you screw up your credit, all of this has to start all over again, to where you have to prove yourself. And we know all the horror things that, whether it's filing bankruptcy, whether it's, fighting this for 7 years, whatever it may be. So be sure that your consumers know not just to stop paying. That's not acceptable, and it breaks contractual law. They have to actually call, get on the phone with, because the world has not shut down. They have to get on the phone with and let their servicer know that they are having a hard time, and here's the reason I'm having a hard time.
Absolutely. Communicate. This is something that I spoke about last week with Billy Alt. Regardless what programs are and what it is that you're hearing, you have to pick up the phone. This is not the magic wand that they wave and say, okay, make no payments. You have to notify your lender. You have to notify your credit cards, your car payment, your house, that, hey, due to coronavirus, I'm out of work right now and I need some help. Can you help me? And then do what they ask you to do. Pay attention, read over the documents, make sure that it's something you're going to be able to perform on. In our industry, when somebody says forbearance, it scares me, because forbearance basically means, so everybody understands, we're going to let you skip this payment next month and maybe the following month, but there's a time period on that historically in forbearance. So if you go 3 months without payments, on that 4th month, that contract is going to say, you owe me 3 payments plus the current one, 4 payments in 90 days. So make sure that it's something you can perform on, because if you can't make the payment today, can you make 4 of them in 3 months?
And make sure that even if you irritate the people on the other line, on the other end of that phone, make sure you understand and get their name, write down everything that they say, because you're right, exactly. With forbearance, a lot of people think that they're skipping payments, and they're not. There are servicers, I'm sure, that are tacking it on the end. So if you were supposed to be paid off in January of 2025 and you missed 3 payments, they may extend it till April of 2025, something along those lines also. So make sure as a consumer, you understand exactly to a T, and don't get off that phone until you understand. Don't let somebody bully you or push you. Don't let somebody who's not going to be there in 4 months let you believe or think you believe what you know. Make sure I would get it in writing, and at the very least, I would write it down and say, I'm talking to Jack Smith. Jack Smith said I am not going into forbearance, that we're tacking these 3 on the end of month, whatever that may be. Make sure that you understand it as clearly as you physically, humanly possibly can.
And ask for it in writing. Demand that you get it in writing. Give yourself some type of ammunition to defend yourself in case it doesn't go the way you expected it to. Make sure that you have all the information. I think that's great advice.
Agreed. One of the things I saw it on Good Morning America. George Stephanopoulos said that car companies are allowing payments to be late, and they're putting them off till the end and things like that. Don't be the one calling Billy Alt to fix your credit and say, but George Stephanopoulos told me this, because he didn't, and he's not going to back you up, and he's not going to make your payments.
Yeah, how often do news articles or reports get retracted because the information was given was incorrect?
Jesus
Was
Christ,
incorrect.
as much as they're reported.
So, and speaking of that, we'll use George Stephanopoulos or however you pronounce his name as as an example. Pay attention to who you get your information from. George Stephanopoulos is not a credit expert. He doesn't know anything about, deferred payments on car loans or anything like that. Make sure that when you hear something from someone like that, that you're reaching out to a Billy Alt and confirming what can be done and get the information. If you're getting information on mortgages, reach out to a mortgage professional and get the insight and what can actually be done. This is something that I've offered out to all my Facebook friends and everybody that watches these is if you have questions on deferring a payment or missing a payment, call me. Call me. My phone's on 7 a.m. till 10 p.m. 7 days a week. I put my cell phone out there for everybody. Call me and let us help you so that it doesn't become a pitfall for you going forward. Call your car dealership. If you've got a guy there, call him and ask them about car payments. If they've got information as someone you can contact so that you're doing the right things. Don't assume that what you hear in Facebook land is true. I think Abraham Lincoln said it best, not everything on Facebook is accurate.
Agreed.
So, make sure that you're reaching out to the people. Everybody, that's one of the great things that I've seen. This is my 5th call at 10 a.m. that we've been doing every day. And the one thing that I've noticed is when I've said, hey, can we put out information to people? Everybody's belling in. People want to help. So reach out and get that help that you need. I want to thank you. I know you're a busy man. You got a ton of stuff going on, but I want to thank you for being on with us today and sharing the information on the market.
Anytime, brother. Anything that I can do, if I can explain anything better, I will definitely try. If anybody wants to reach out, I'll definitely help. Whatever I can do to help you guys right now, just let me know what that is.
Absolutely. And I want to put the offer out. If you need help with social media marketing or anything like that, we're here to help. We know that it's unprecedented that you don't get to go knock on doors and send postcards and hand out flyers and, hey, I sold your neighbor's house type stuff. Give us a call, reach out. We'll show you how to do that remotely, and we'll help you guys continue the marketing because the people that are working now are going to be the ones that are working overtime come when this comes out. So
they're going to be the ones needing to hire assistance whenever this market shifts.
Absolutely. Well, I appreciate it. I'm going to let you go and get back to work. Thanks, guys, for tuning in, and we'll talk to you later.
Thanks, sir.
Yep.